Hey everyone, welcome back to another episode. While a solid trading strategy can help boost your account, proper money and risk management are what keep you in the game. In today's video, we'll cover top-tier money and risk management techniques aimed at reducing exposure and growing your capital efficiently. We'll break down how to handle active trades and manage your mindset, which is key to catching high-risk to reward setups. So, if you're into mastering advanced trading principles, understanding entry setups, and staying consistent with a trading strategy, make sure to hit that like button and subscribe to the channel. We share tons of deep trading content. See you right after the intro. So, what exactly is money and risk management? Risk management is the process of recognizing and reducing potential losses, whereas money management is about smart allocation and safeguarding of trading capital. Both aim toward the same objective, achieving sustainable long-term growth by protecting capital and maximizing profitability. Now picture the market trending upwards. We spot a support level along with a reversal candlestick setup. So, we enter a long position at the close of the engulfing candle, place our stop loss below the doji, and aim for a target that's twice our risk. Say our account balance is $1,000, our position size will decide what portion of capital we risk if the trade hits the stop. If we choose to risk 5% of our account on this setup and the trade fails, that's a $50 loss. Even if we win just one trade out of every three, we'd still be breaking even. Not too bad, right? But now imagine losing 5 trades back-to-back in a rough trading week. Something every trader goes through. That's a 25% drawdown in just a week. Think about how frustrating and damaging that can be for future trading decisions. Blowing up your account doesn't mean hitting zero. Once you've lost half, the psychological pressure alone can take you out. This is exactly where money management plays a critical role. If we limit our risk to just 2% of the starting account balance per trade, then even with 5 consecutive losses, we'd only be down 10% of our capital. A drawdown that's much easier to recover during profitable trading sessions. Later in this video, I'll break down some powerful money management strategies designed to help you boost overall gains. Now let's move forward with risk management. How exactly does it assist in this trading scenario? Suppose after entering a buy position, the market moves against us. Following a break and close below support, we can anticipate further downside, possibly hitting our stop. While our stop hasn't been triggered yet, closing half the trade at a loss can help us retain 25% of the original risk on this losing setup. On the flip side, if the market aligns with our expectations, there's always a chance of a reversal that could turn a winning trade into a loss. Taking partial profits before hitting the final target is another effective risk management method. In essence, risk management is all about recognizing and reducing the threat of unfavorable market conditions. Let's now dive into the basic principles, guidelines, and formulas behind money and capital management. How much should you risk per trade? The answer mostly relies on your personal risk tolerance. Risk tolerance refers to the amount you're mentally and financially comfortable losing during inevitable losing trades. It involves evaluating risk per trade in relation to your total capital. Ask yourself, what percentage of your account are you okay with putting on the line, and potentially losing, if the trade doesn't work out? Secondly, if you hit a streak of 5 consecutive losses, what level of total account drawdown would still let you trade without emotional interference? Based on your responses, you can build a reliable money management system, one that shields your emotions from taking over. If you risk more than you're mentally prepared to lose on any trade, your emotions will likely dictate the outcome. For instance, if you risk 3% of your starting balance per trade, 5 losses in a row would eat away 15% of your account. So, why not risk smaller amounts instead? Because your trade risk also determines your potential profit. Take a small account risking just 1% per trade with a 1-to-1 risk-to-reward ratio. You'd gain only 1% per winning trade. If that doesn't feel worth the time and effort, motivation drops. That's why your money management plan must be balanced. Wins should fuel your progress, and losses shouldn't break your spirit. If I were just starting out with a small account, I'd likely risk around 2 to 3% of capital per trade. So now, how do we calculate our position size when trading different pairs? Position size calculation depends on 3 key factors: the percentage of your account you're ready to risk, your total account balance, and the number of pips to your stop loss. So, let me show you a position size calculator tool and how you can integrate it into your money management strategy. But before we move ahead, if you've been finding value in this video so far, go ahead and hit that like button, and drop your thoughts or questions in the comments below. The money management principles we covered earlier focused on capital preservation and long-term survival. But now let's talk about how to grow that capital. When you're on a winning streak, one of the safest ways to increase your risk, without letting emotions interfere, is by transferring a portion of your profits into a secondary trading account. In this second account, you can take larger risks than usual to test your growth potential. The key here is that you're only risking profits, not your core capital, which helps you stay emotionally grounded. Additionally, make it a habit to withdraw a portion of your profits monthly and spend it. This keeps you motivated and committed to the long journey ahead. If your goal is exponential account growth over a long stretch without any withdrawals, chances are you'll hit a mental roadblock along the way. Now that we've covered the key money management strategies, let's now dive into some key risk management strategies and how to handle open trades to boost your profit potential. We'll begin with one of the simplest yet most effective methods, setting a trade to break even. Picture this: we have an uptrend forming higher highs and higher lows, and we decide to follow the dominant trend. We enter a long position and place our stop loss just below the recent swing low. Our target is a key level on the higher time frame that may act as a potential reversal point. This trade setup offers a 1 to 5 risk to reward ratio. But chances are, you've experienced a trade running in profit only to reverse and stop you out, turning a winner into a loser. Or maybe you've exited too early and missed your full target. To avoid these situations, many traders use a break-even strategy to relieve emotional pressure. When the price moves 2 times your risk in profit, you can close half your position to secure gains. Alternatively, open 2 separate trades with half the original risk, one with a 1 to 2 risk to reward target. Once that's hit, you've locked in profits. Even if the price comes back to your stop loss, you're at break even overall. Then, let the second trade ride stress-free to your long-term goal, or exit early if necessary, like during high-impact news events or at the end of the trading week to avoid slippage. Now let's move to the second technique, tracking profits up to the higher time frame key level for exceptional risk to reward trades. In a bullish scenario, after entering your long, each time price breaks structure higher, shift your stop a few pips below the new swing low. This approach lets profits run until the higher time frame key level or a reversal is reached. Let's examine a real chart example. On the EUR5 United States dollars minute chart, price has reacted to a significant structure level, suggesting it could mark a turning point in the ongoing downtrend. The confirmation we need to go long is this double bottom formation, which signals a potential reversal setup. We'll place our stop loss just below the swing low and set our target at the next visible level ahead on the higher time frame. From here, we'll let the position play out, and with each new bullish structure break, we'll move our stop loss just beneath the latest swing low. This method allows us to ride the trend and secure high risk to reward trades, all while protecting our profits along the way. These are just a few practical money and risk management methods that can be tailored to fit your personal trading system. If you've got any other strategies or insights on this topic, be sure to drop them in the comments and share with the trading community. That's it for now, traders. Appreciate you watching. Alright traders, I hope you found some real value in today's video. If you did, don't forget to tap that like button to show some support, and if you're new here, make sure to hit subscribe and join the community. Catch you all in the next episode.